formally thank you very much, Matt Bartolini from State Street, for being on the show with me, and of course Patrick Bobbins as well. Thank you very much for joining me in the show. I really am totally pumped on this because we're at such a pivotal point in the markets where internally we have the same debates that we're going to have today. Of course, it's not live necessarily, but that's besides the point. So anyway, before I keep going, Matt, maybe tell us a little bit about yourself for the 5 people in this world don't know you.
Well, I'm Matt Bartolini. I'm the head of Spider Americas research at State Street Global Advisors. And obviously, Spider ETF's third largest issuer in the U.S. and in the world. And we have over 140 different ETFs, many of them focused on U.S. equities and international equities, as well as fixed income. But we also have a full range of active suite as well.
And Patrick, give the audience a little bit of your background. I mean, it'd be helpful.
Dan, thanks for having us again. My name is Patrick Bobbins. I'm a vice president at Wealth Enhancement Group. As part of the Carroll team, we were a $5 billion RIA based in Charlotte, North Carolina, before we partnered up with Wealth Enhancement Group a few years ago. I was the director of investments and research at Carroll Financial Group, where we managed about $5 billion under management. So excited to be here and be a part of the think tank.
And today you're at Wealth Enhancement Group.
Correct. Still managing the Carroll Group's assets, so a few $1 billion here. So the views are my own and that of my team here in Charlotte. I don't sit on the kind of broader investment group of Wealth Enhancement Group, but more local Charlotte opinions.
Awesome. So for those who don't know me, of course, I'm Dan Weiskopf, the ETF professor and also a member of the investment team at Tidal Financial Group. And I love hosting these shows because we brainstorm together. And in the ETF think tank, we talk to financial advisors on a regular basis about idea generation and research. So this is really an extension of that. And we look forward to the discussion. So with that, we've covered everything. We've done the disclosures. Let's just jump right in. Okay. Maybe, Matt, you can start with some context of what you're hearing from financial advisors, and then we'll go into your outlook. And then, Patrick, you can do the same.
Yeah, I mean, right now there's just a general degree of caution in the marketplace, and this is revealed in some of our investor conversations on how they're positioning portfolios, but also from what we're seeing from fund flows. If we look at it on a year-to-date basis, fixed income ETFs are at around 73 billion, while equities are around 40 billion. And if we look on a rolling 3-month basis, right, if we try to look at trend, fixed income ETFs have been outperforming or outgaining, gathering equity ETFs, and typically that doesn't happen. So this more preference for fixed income, that defensive asset, alongside increasing exposures and inflows into gold, really underscores a sort of cautionary type of positioning. But also think about it from a lack of positioning or a lack of investment on the equity side. There's really a hesitancy to buy into this rally, particularly given as the rally is being driven by just a handful of stocks, because market breadth is actually quite low. So there's a really strong degree of caution, but we have started to see some courage implemented as well when looking at the beneath the surface equity flows, because there have been a significant amount of inflows into non-US equities, particularly into the European region. That is where the money is going. So there's this preference to focus overseas. But more broadly, there is that defensive, focus, hesitancy, caution type of approach. And you can even see this in different AAII surveys where you look at cash allocations or money market mutual funds, bond allocations. There really is just a lack of conviction to buy into this rally in some sort of a full-throated way.
Patrick?
Yeah, so I'm probably one of the few folks in the professional industry that was excited that last year actually happened. Last year was an amazing reset for interest rates. We finally got back to a more normalized rate environment, which if you think about allocating capital on a risk basis, I can now get 5, 6, 7% from bonds where I haven't been able to do that in about 14 years, right? We've been in this 0% rate for 14 years. And last year we finally got off of it. And that was a blessing. So I'm very optimistic about kind of what's going on in the fixed income land. Not as optimistic on the equity side as kind of Matt alluded to. We're kind of at stretched valuations, handful of names leading the market higher. But it's again, it's a blessing. You don't have to participate if you don't want to, because you can get that mid-single digits, possibly double digits. I know we'll get into kind of the different sectors of credit later, but you can get equity-like returns in the bond market, and we haven't been able to do that in a while.
Yeah, when I look at where we are, I think it's pretty evident that most financial advisors are sitting on a lot of cash, or treasuries, whatever you want to call cash these days, right? And so if we have some sense of optimism, you can see equities really rally, right? Mark, or actually, sorry, Matt, talk to us a little bit about your outlook, right? And
Yeah, so I mean, even just to the point around sitting on cash, I mean, if we look at even fund flows on ETFs, one of the biggest gatherers and within our lineup has been a 1 to 3 month T-bill ETF. That is effectively the risk-free rate. So even from that perspective, whether it's sitting in straight cash deposits, which is, we've seen that, or just going into cash-like ETFs, that is definitely a defensive focus. So within our outlook, it is I used the term earlier, caution and courage, and that's kind of where we're at. There's reasons to be optimistic, but then there's also reasons to have a pessimistic view. Within the U.S., more broadly, valuations are expensive. S&P 500 trades above historical averages, whether you're looking at it on price to earnings, price to book ratio, price to sales, what have you. Also, at the same time, that multiple you're paying is for decreasing earnings. Earnings sentiment is negative. So earnings expectations for 2023 are negative, are forecasted to be negative. And we're actually forecasting Q2 2023 earnings to be negative. Again, that would be essentially 3 consecutive quarters of negative year-over-year earnings growth. You also have more downside revisions than you do upside. So sentiment and growth is negative, valuations are high. That really does not represent a very strong case to own broad-based U.S. equities. There's actually a stronger case within equities to to move up in quality. Owning those areas of the market that have less fundamental volatility and have more durable balance sheets and consistent earnings would actually be more preferable within the U.S. So that's our sort of view on U.S. equities. But we have a far more constructive view on overseas equities, particularly Europe. So non-U.S. equities, if you look at it through 3 traditional quantitative factor lenses, valuations are constructive. Valuations for non-U.S. equities are below their historical averages. Meanwhile, earnings sentiment is improving. So earnings expectations have increased over the last 6 months and the last 3 months for full year 2023. And price momentum is strong. So those 3 quant factors, momentum, sentiment, and valuations, all have the arrow sort of pointing up for non-U.S. equities. Also, I think it's a little bit under-owned. If we look at it from even just an asset class perspective, a lot of people had shed international assets, particularly European, just given how poor the performance was coming out of the great financial crisis and really the 10, 12 years after that. So I think for those reasons, we like the non-U.S. equities. On the fixed income space, we continue to like that sort of short duration market, the ability to get, particularly in the 1 to 3 year corporate space, a 5% yield, which is on par with the earnings yield of the S&P 500, but with 88% less volatility than stocks. And we look at it from a duration and spread perspective. Duration and spreads right now on 1 to 3 year corporate bonds are in line with historical averages. Meanwhile, the yield, because of what the Fed has done, is well above it. So you're able to obtain a yield of 5% without taking on any more duration or spread risk that you would have in the last 20 years. Meanwhile, you're lowering your volatility profile within bonds that is 55% lower than the ag. So this is one thing that we like to talk about is balancing or striking a better balance of yield per unit of volatility, because bonds, even though they are higher returning, they are of higher risk. I'll leave this one last point, is that the standard deviation of the Bloomberg Ag over the last 90 days is in the 97th percentile historically. So the realized volatility of bonds is at its highest level in over the last 30 or so years, far more than it was during COVID or during the Great Financial Crisis. So I think bonds are risky, but they do have that higher return prospects. So you have to balance that out, and that yield per unit volatility metric is one way to sort of ascertain the areas of the market that could be more ideal.
Patrick,
Yeah,
you
I
go ahead.
always love the outlook question, because I think as professional investors, predicting anything is rather difficult. Most people get it wrong. What we can do right now with a lot of accuracy is observe. Let me flush that out a little bit. So I'm going to pick up on a few things Matt mentioned. One, I think, observing the rate curve, it is indicative of a future recession, right? We've got an inverted yield curve. So how do you benefit from that? Well, I agree with Matt's point about owning that front end. Floating rate treasuries yielding 5.3. That's a fantastic way to kind of scoop some cash up off the sidelines, still beat inflation on that. The rest of the treasury curve really doesn't outpace inflation at this point. So I can observe that relationship. I can also observe current valuations in the equity market, where a lot of the large kind of legacy technology names are trading in that 30 plus times earnings, and their earnings are growing slower. So is that really a great indication of a future 3 to 5 year return? Probably not. Then I jump overseas and I can look at a discount of, call it 30 to 40% from a valuation perspective relative to the US. And that's been in place for a while. But it's also on the back of a 30 or so discount on the dollar relative to euro or yen. So I pair both of those together and I can observe a 60%, give or take, I'm rounding, 60% discount already baked into the international markets. So observing those relationships, predicting the next 12 months, I think is futile. But as we put together a longer term plan for folks, or try to guide, the best source of possible return over the coming years, I don't know what the market's going to do this year. Nobody does. Nobody probably expected us to rip up, 10% or so right now. Nobody expected the market to go up in 2020 when the whole world was shut down, but it did. So predicting the short term, I think, is kind of a futile investment. But as I sit and wait and observe more information, I can pick up 5 on the front end. I can buy something that is dramatically discounted overseas, and we'll get into credit, but I can pick up levered loans paying yield the worst of about 11. I can make a portfolio with that.
Patrick, I mean, in fairness, people expect us to try and predict things, right?
Oh, for sure.
And I get
Absolutely.
it, and the funny part is the market will make you humble every time, and people will get it wrong. I'm
Yep.
totally with you on that. Speaking of predictions, what's your view on the dollar? I'll throw it at both of you, right? Because that's something that everybody's talking about, and maybe it's a little media hype. Don't get me wrong, but maybe you have a view on the dollar.
I'll take it first, Matt, if you don't mind. I
Yeah, go
mean,
ahead.
it kind of relates back to the statement that you can look at a relative purchasing power and say that we're about 30 or so percent undervalued, or overvalued, I should say, rather, relative to euro or yen. But let's just look at a basic budget, right? We're borrowing $1.4 trillion. Our interest expense is about $1 trillion right now in the US. You've got to continue to print money. There's no way around it. We're in budget talks right now, right? We talked a little bit about this before the call. Neither side can agree on anything. It's not like we're going to come up with a $1.5 trillion spending cut this year. So we're going to keep printing. So my view on the dollar long term is negative. I would say this year we're poised to go a little bit south as well. But over time, if you look relative to gold, we're in a fiat currency. The dollar's by definition going to go down.
Yeah, and I would say, our currency team's view is short term neutral to bullish. And bullish, I just mean that, they think it could be a little bit of an up move, but not much. But long term has a negative view for some of the same reasons, but also valuations are a big driver of that. We look at, coming into this year, the dollar was at cyclical peaks, basically 20-year peaks. And so there's some mean reversion that was going to take place. So longer term, the view on the dollar is that there's likely more room for it to move lower. In the short term, there could be some flight to quality, flight to safety, particularly around the debt ceiling debate. Even though, who knows what would happen to the sovereignty of the U.S. and how that would affect the dollar. But back during 2011, the dollar did rally. So, that's just something to keep in mind. But if you're investing for, longer than the next 2 months, which I think everyone is, the view on the dollar is that's likely to be moving lower. And for non-U.S. equities, that's going to be a tailwind for earnings. And then for emerging market local debt, that's an area of the marketplace that we've talked about as a way to get yield. That type of market is heavily predicated upon currency risk and currency volatility and currency movements. So areas like that are another segment that could benefit from a weakening dollar.
Matt, let's run with that for a second, because I think emerging markets are extremely underowned. People are afraid to touch China here in the U.S. for sure, but the projected return on that asset class is above U.S. and I think above international too. Please expand a little bit on the emerging markets.
Yeah, so the case for emerging markets, it boils down to one, and it's valuations. The valuations for emerging market equities are far more attractive than they are for developed non-U.S. as well as U.S. The only one that's probably not as attractive would be U.S. small caps. And there's a reason for the attractiveness from a valuation perspective. Earnings sentiment, earnings quality is significantly poor for both U.S. small caps as well as emerging market equities. So momentum also isn't that supportive. Really, it just comes down to valuations. And when you're doing those sort of 5-year return forecasts, all it is just again, I'm probably being far too simplistic and hopefully not derisive of anyone's process, but essentially just a value screen. Based on this PE, then forward-looking returns over the next 5 years historically have been this, and then you throw in a couple qualitative assessments, and there you go. So it's really just a value play. And I would rather, and we do this in our asset allocation portfolios, our TAA, tactical asset allocation portfolios, I'd rather take that value play where there's stronger earnings sentiment, and that's within developed equities, particularly Europe. So the case for emerging markets is really if you just have a steel stomach for the geopolitical risk that goes along with it, and you like the value play. But again, there's better value plays out there with stronger earnings quality.
Patrick, share.
Yeah, this might be more of an answer than what you're looking for, Dan. But you think about why emerging markets did really well over the past 20 years. It was off the back of China manufacturing base, right? China came into the market, they came into the world economy. A lot of the production went there. And you had a lot of the other emerging markets supply them with raw materials, et cetera. So China raised all emerging market boats. Do we expect China to continue to grow at the same pace now, given their economy, the political dynamic, the debt in the system? Probably not. I also think COVID taught everybody a little bit of a lesson in terms of supply chains. Maybe we don't take risk dominated in one country compared to maybe making goods more local or more regional. So I think it took 15, 20 years to outsource the manufacturing over to the cheapest source. I think it's going to take another 5 to 10 years to bring it back home or find a better balance. So I do like some emerging markets that supply the raw materials, but from a emerging markets broad-based index that's dominated by China, probably not a fan.
Now, in the pre-show or the prep show, we were talking about some context. We've thrown a lot of predictions out here, but one of the things that I was most surprised about was, Matt, you've got a real positive outlook here in the U.S. Can you speak to that a little bit? Given some of the statements you've made, I'm kind of surprised. Go ahead.
Yeah, so in the positive view is around the recessionary tendencies. And, there's this desire probably to want to be the one that sort of says, yes, I'm always on board with the recession. The indicators are pointing this way. And look, that there is a lot to it. If we look at the yield curve as a predictor, right? So since 1960, it's predicted recessions within between 6 and 24 months, which is a gigantic window. I mean, you technically could have 2 children in between that window and still no recession. However, there's only been one false signal, and it's 1960. Okay, well, the yield curve's been inverted technically since last April. We're inverted for a couple days, then it persistently inverted in July. So if you run this forward, we're basically at the midpoint of this recessionary yield curve predictor window. So an optimist would be like, well, we haven't had it yet, and the consumer continues to remain strong and labor is strong, so perhaps that could juice us past any sort of recessionary pressures. The pessimist would say, well, leading economic indicators are also negative. So if you look at the LEI year-over-year change, it's negative and been declining for 9 consecutive months. So the only other time it's been declining and negative for 9 consecutive months is 2009 and 1975. So while the decline is only minus 7.8%, so the depth isn't that long, the duration of this decline has been pretty close to abnormal levels. Also, the weakness has been somewhat broad-based. So the other LEI index that usually doesn't get mentioned a lot, but the diffusion index. So basically it looks at the breadth of the indicators. Above 50, that means more than half are moving higher. Below 50, less than half. Right now, that number's 25. So only 25% of the LEI indicators beneath the surface are actually positive. So there's a lot of breadth associated with the weakness. The one area where it's not is labor. Labor continues to remain strong, and I know there's jobless claims have started to tick higher a little bit, but if we look at even the JOLTS report, and yes, it's softened, but the number of openings is far greater than the number of openings we had in 2019. Real wages continue to go up. Inflation-adjusted disposable income continues to go up, and that's really a main support for consumer spending. Consumer spending was up 3.7% in the last Q1 GDP report. That drove overall growth because growth was just up 1.1%. And if we look at sort of inflation-adjusted consumer aggregate demand, so sales to domestic purchasers, which is basically the whole thing of our economy, that was up 3.2%. So labor continues to remain strong. The home builder sentiment index that came out yesterday, higher. Home buyers are witnessing more foot traffic. Other sentiment indicators have come off their bottoms, whether it's the Michigan Consumer Confidence. So there's reasons to be optimistic that we could avert a recession. I'm not saying we will, but the sort of foregone conclusion that the yield curve would predict a recession, 6 to 24 months, pretty wide. So I would always sort of want to not rush into a conclusion, particularly even if the recession is shallow, because we haven't had a full-scale recession without labor cracking. And the employment to population ratio is at 80.8%. That's the highest since 2001. So there's a lot of labor weakness that has to happen before it really, really drags down the largest part of our economy, which is the consumer. So I guess I'm probably being two-tailed. There's a little bit.
No. Listen, you made my day with that forecast, to tell you the truth, because most people try and get attention for predicting the end of the world.
Yep.
And it makes for great headlines, but I don't think extreme predictions, frankly, are very productive. So I like what you're saying. I really do, and I appreciate the optimism, and I think there's reason to be optimistic. Patrick, you had a similar or different view.
Yeah, Matt, I think Matt pointed out a lot of the positives, so I'll let those stand. Not going to really poke holes in all of that because it's the data. It goes back to one of my prior comments. We've had 14 years of basically 0% interest rates. We're now off of that by a large margin. Things are going to break in stages. So what we've been kind of sharing with advisors and clients is this idea that expect more things to break, but not all at once. So last year, what broke? A lot of technology names, a lot of high-flying growth names that were priced at 1,000 times earnings. Those broke. We can go back a little bit further and say cryptocurrency broke, right? A lot of the meme coins or whatever it is. This year, what's breaking? Regional banks are starting to crack. You can't really argue with that one. They've taken a hit. what breaks next? Well, some brick and mortar starting to go under. You're starting to see some issues on the commercial lending side of things. Office spaces are looking a little problematic. So it's not that we expect this massive wall to hit at once, but I think there are certain risks that the more those work their way through the system, that positivity that Matt conveyed could easily start to be chipped away. And you pair that environment with, again, Matt's comment back to the breadth of this rally. If you strip out the top 5 names of the market, you're actually negative on the return. So what's driven this market higher is a handful of names. Those names are priced pretty expensive. So the moment that you start to get a little bit of chipping away at the positivity or the numbers, you could easily start to see this thing come back down. So it's not that I'm doom and gloom. You know, I'm not going to predict the end of the world, Dan. Hopefully that wasn't a jab at me. We can have that at a later conversation if you want, or over a beer. But, you know, the idea that something breaks after 14 years of 0% interest rates is very reasonable. We're already starting to see the chinks in the armor.
Yeah, and I think one of our views is that you want to diversify these recessionary risks. You want to own things that would work well in recessionary periods, even if it's brief. So things like gold or defensive equities. But acknowledging that there are pockets, isolated pockets maybe, but pockets of strength, like consumer balance sheets. So home builders would be another area. Because, you know, mortgages have come down off their cyclical peaks. And if the Fed does, you know, start cutting rates, that could be another benefit. But still, those disposable incomes are going higher. Savings rate is going higher as well. And I think in terms of, you know, even the regional banking crisis or mini crisis, what have you, a lot of that sort of just filters back to the underlying consumers and customers that they served, which was mainly tech. So I think it continues to be that sort of follow-on of that tech breaking, of the growth stocks, of the zombie stocks that don't actually earn anything, that don't actually have an identifiable business model where they're selling something at a profit. They're just basically focused on, you know, subscribers, right? And they can hit a subscriber number. I mean, look what's going on with, again, not to get too company specific, but, you know, Disney with Disney Plus. It was all about subscriber growth when you had 0 interest rates, and now it's about actual cash flow. And I think that one little anecdote is actually far more important for a less diversified multimedia company than Disney. You know, there's other firms that were out there that was their only business model, and you know, it's very easy to be profitable when your opportunity cost is 0 in sort of real rates. When real rates move higher and your opportunity cost is now much higher, things break. And I think that's what happened last year, and there's still some after effects to that too, right? And then we talk about that, about how the Fed's rate decisions still have yet to fully impact every portion of the economy. It's sort of this, you know, this idea of like a rolling recession. And we always think about recessions in sort of 3 dimensions. You have the duration, how long they are, the depth, how deep it is, and sort of the decline of GDP, but then also the width, right? Is it shallow? I mean, is it wide or is it narrow? And I think this one is going to be, if it is, or already has, would be somewhat narrow, right? I think it would be very bifurcated towards those areas of the marketplace that were only benefiting from the fact that we had 0% interest rates.
Wow. So by the way, Patrick, I wasn't pointing the finger at you in terms of being extreme at all. Actually, I think your view is pretty balanced. But to Matt's point, let's talk a little bit about credit, because I'm a believer that credit is an indicator of economic strength or weakness. Certainly, it causes weakness if credit is restrained. Talk to us a little bit about credit and how you're playing it and what your outlook is.
You want me to start with that one, Matt?
Yeah, go ahead.
Okay. I think it's important in this environment to be selective in the credit that you take. I like the idea that you remain, and I'll just lay out kind of what we're doing. We're anchoring on the quality side, high-end, you know, short-term treasuries, AAA CLOs yielding between 5 and 7% yield or worse. That's kind of where you can anchor in and get a very good rate of return in high-quality bonds without taking duration risk. On the other side of it, you have to look at where you're getting paid for the level of credit that you are willing to, or credit risk that you are willing to take. And I'm more referring to, high yield bonds, junk bonds, floating rate, that sort of thing. And I would look at it as, all right, high yield and floating rate, you can argue that they're about the same level of credit risk. You're getting a similar credit feel of the underlying company. Bank loans are a little bit higher in the cap structure, you could argue. And I'm getting 11% yield to worst on that, whereas high yield is around 8. So I want to be selective in taking that levered loan position over a high yield position. And I think Matt referenced this earlier. I think an active manager in that bucket makes a little bit more sense because cash flow is important in this environment. Interest coverage is very important in this environment as companies are faced with refinancing that debt in the coming years. You want to make sure that they've got the cash flow to cover it. And the last thing I want to do is own a broader basket or a broader index of levered loans or high yield, because you're getting overexposed to potential weaker credits in that environment. And it's not saying that those can't do well or can't hold water, but there's the idea that active managers don't own a bond that defaults, right? They've already sold it because the cash flows look poor. And so that's kind of that ongoing due diligence idea that you want to be selective while taking higher or lower credit risk, I should say.
Yeah, and I would broadly agree with that. I mean, where we're sort of thinking about from an implementation perspective, having a more selective credit strategy would be beneficial. And the ability to go into different areas of subjective credits in terms of high yield, CLOs, senior loans, and mix in that type of exposure to create, in some case with senior loans, a very defensive type of credit exposure because of, their seniority in the capital structure, particularly if there's an expectation for default rates to tick up. I mean, the expectations for default rates for the next 12 months are around 3 to 4%, which is, higher than we had saw prior to the pandemic as well, or even just the last, year and a half. So we do like credit from that perspective, but being more selective because the entry point is quite attractive. If you look at just broad-based fixed rate high yield, that's 9%. And we know from a long-term investor's perspective, the yield has a very strong relationship with subsequent returns. If we do a return decomposition or attribution over the last 20 years, yield and coupon and the reinvestment of that makes up more than 100% of high yield return. So 9% is pretty attractive if we look at it for sort of forward-looking expectations of returns. The other area in the fixed income market where if you want to take spread, and this more is, again, trying to be a little bit more defensive, maybe extending a bit on duration, is within mortgages. So mortgages are a defensive asset class. They do take a little bit of a spread over treasuries, but continue to have a negative or low correlation to stocks depending on your look-back window. But you do have this idea where duration is extended. Duration right now on mortgages, and I'm talking agency MBS, is it basically at all-time highs because of all the extension risk as a result of the Fed hiking rates so aggressively. So if the Fed obviously pauses and maybe pivots towards cutting rates, we could see some refinancing perhaps, but at least that extension risk is not going to be much of a headwind, and that duration could start to come down. I mean, the last time duration in mortgages was above 5.8 years, mortgages return 9% over the next 12 months. So I think that's just something to consider. And in terms of how you're taking spread risk, there's ways to do it while jumping full into high yield. We're obviously going to take around 480 bips over treasuries. Or you can do something in investment grade. We already talked about the 1 to 3 year space where you are going to take some spread risk, but not much. Or even in mortgages where, again, you're going to take some spread, but it's, again, not significantly higher than what you see even within broad-based corporates. It's roughly around 30 or 40 basis points.
Yeah, I've got to agree with Matt on that. The middle part of that bucket, the agencies and even a little bit of non-agencies, I think make a ton of sense in this environment. It's probably one of the least levered assets out there, right? Home values have dramatically increased over the past 10, 15 years. Consumers are locked into their houses because no one's going to want to move and take on a new 6 or 7% mortgage when they've got a 2 or 3. I unfortunately did that because we had a expanded family and then we had to move. So I'm the sucker that got stuck with a new 6% mortgage last year. That's okay.
Somebody had to sell too. Just remember that you helped them
yeah,
out.
exactly. But this idea that you can barbell, right? You can kind of shoot on both ends, short-term high quality treasuries or CLOs and take no duration. On the far end that we were talking about, your high yield and levered loans, those are getting you the 9 to 11. There's a pretty good middle bucket there that you can get that 6-7% number that Matt was talking about. We love that space too.
The truth of the matter is, and I think people have forgotten about this, we were incredibly spoiled, at 2 to 3%. Right? It was free, right? We may never see that again. And to your point, Patrick, 5-6% mortgage, you know what? That ain't bad, right? No. And you'll refinance as rates come down. And it seems to me that, and I think, Matt, you would agree with this, the expectation is that inflation now is under control. At least you see it in the tips outflows. I don't know if it is, by the way.
Yeah, I mean, honestly, there could be a fantastic study done, and maybe, my team can do it, around buying behavior and investor activity for tips ETFs. It's just always seems to be wrong. Like either too early, too late, too wrong. It's always a bad signal, and we have a lot of conversations about how to use tips. It never should be used in unison. Like just buy tips to hedge inflation because you're still taking rate risk. You have to do it as a relative trade. Sell your nominals, buy tips, those type of things. Inflation under control. I think it's obviously has moved subsequently lower over the past 9 consecutive months, but still 4.9%. And there's still inflationary pressures out in the marketplace, particularly whether it's home prices, automobile prices. Some of the decline in inflation is just base effects. You're coming off of a very, very high level, so some of it is just math. I think if we even just prorate out the rate of change, the average rate of change, I think, is like minus 5.5% over the last year in CPI. Like if you just do that, prorate it out, it won't be to around 3.5% until August. And I honestly, for me, I keep circling the date around Jackson Hole. We've obviously seen over years that symposium is used to declare changes in monetary policy. And if you can get inflation down around 3.5%, and it's around August, which is Jackson Hole, that's when you start to see the Fed really start to probably talk about cutting rates and really start to use that forward guidance to get the market prepared for it. But I don't think the Fed, they have a better handle on it. They have one hand on the wheel, but the car is still sort of rattling around.
Yeah.
Patrick, you agree? It sounds like it.
I don't know. I think inflation that we experienced at the 2% level that over, the last decade is gone. I think having inflation in that 3, 4, 5 range even makes sense. And, the bond market is telling you that we've already killed it. 10-year rates back at 3.5. That's still giving me a negative real rate of return. I don't get excited about that. And so, Matt, I think you have an interesting point. Like, do we get back to that 3.5 level by Jackson Hole? Maybe, but I'm still now break even on a 10-year note. That doesn't get me excited. So does the Fed really have to cut if inflation's still at 3.5? I don't think so. I mean, if labor markets still remain intact, you don't have a big recessionary event, you still could sit here at the 5.2, whatever range we're at now at the front end for a while longer and get better than inflation returns on the front end. Yeah, I'm waiting for that back into the curve to drift up a little bit and account for that potentially higher inflation level longer term. And it is paired with that comment I made earlier about China's growth. It was a huge deflationary event for us. And if we have this relocation of supply chains, et cetera, it's going to cost some money. We got to bring it back over here. That might be a little more expensive. So you might pay a little bit more for your TV or whatever good you're going to buy versus what we've been doing making it in China. So I think longer term inflation might be at elevated levels versus that 2.5 range that everybody's trying to target.
Yeah, I would say like the Fed has a dual mandate: price stability and full employment. And if you have a 3.5% inflation rate and employment is at 4%, that seems like they've achieved their dual mandates. And I think that has to be taken into consideration. The labor market has started to show some softening, but it's not weakening, right? Those are two very different terms to use to describe the labor market: softening versus weakening. And I think that's just something we're obviously keeping our eye on it day over day.
So we've been talking about inflation. I, for one, personally, am not going to accept a pay reduction, which is embedding, inflation, right? People are used to getting paid a certain amount, in other words, right? At this point. Talk to us a little bit. This question comes from Cynthia Murphy, our director of research in the ETF think tank. Talk to us a little bit about how different sectors are going to perform, both from the standpoint of credit as well as from the standpoint of equity, because not everything's uniform right now.
Yeah, so there's sort of two ways to look at this. The first one is, what type of companies could potentially be shielded from ongoing wage inflation, which that's been a big driver, right? So you want to look at operating efficiencies, capital efficiencies, labor efficiencies within the organizational's operating structure. So you can look at revenue per employee, things along those lines. Real estate tends to do well, right? Real estate does not have a lot of employees in terms of the functionality. But when we're looking at it in terms of the economic output and what could help us skirt a full-blown recession, it's those consumer-centric areas of the marketplace. So ones that are able to benefit from a continued strength in consumer spending, and that is something like home builders. Home builders, we've started to see upticks in sentiment from the Home Builders Confidence Index. From an earnings perspective, earnings downgrades have moved subsequently lower every month leading into the spring. And earnings expectations have been, or earnings results have surprised to the upside at a far greater rate than what the S&P 500 firms have done. And you still have home builders, because of all the weakness in the past year, they're still trading at attractive levels. So we like those consumer-centric areas like home builders, but also transportation stocks. The ability to sort of hone in on, again, this idea of reshoring, cargo shipping, transports, trucking, rail, alongside passenger travel. If you look at transportation indices, they basically are roughly around 40% of they roughly have about 40% in transportation travel. So, passenger travel, I should say. And what we know from airlines, particularly in the U.S., they're running at basically 97% capacity of 2019 levels. They're actually forecasted to be finally profitable this year after many years of unprofitability. So again, that's another sort of consumer-centric area of the marketplace. Now, one could argue, why not retail? Brick and mortar continues to have sort of secular headwinds towards it, whether it's the Amazon effect or not. That continues to sort of be a little bit of a hesitancy to say, even though retail sales were positive, retail sales the other day came out really strong. But I'd rather focus on areas that perhaps have a little bit more tailwinds to them, like those other two consumer-centric areas that also tie back to aggregate demand as well.
Yeah, I'll take a little bit of a different approach. I like to look at, what are we paying for the value of earnings and value of cash flow? And I would argue that cash flow yields in the natural resources and energy space are through the roof. And if you think about what those companies did back in 15 and 16, when energy prices really blew up, they started managing their capital stack a little bit better, right? They didn't go out and drill for new wells as much as they used to, or overproduce. So I think that you're getting paid to take that level of risk. And I would argue that a lot of the policies are probably putting a floor underneath oil prices and that sort of thing. So love the cash flow yields on the energy natural resources play. And then to be a little bit more aggressive, I like to look a little longer term. And biotechnology, I think, really makes a lot of sense right now. You're starting to see drug trials come back into play after being shut down for for COVID reasons. And you pair that with an environment where a lot of large cap pharmaceuticals and drug manufacturers are sitting on a lot of cash. Those are natural buyers for these biotech companies. And so if you're getting through positive drug trials, positive treatment trials, that sort of thing, and you have a natural buyer for them on the other side of the coin, this could set up for a nice tailwind. And it pairs nicely with the whole demographic conversation, which is something completely separate. But by and large, if I'm looking for something on the growth side, love the biotechnology names, small cap biotech, and then also on the more defensive side, energy, natural resources.
Wow, interesting, because if you start talking about biotech, guess what? You don't have to worry about earnings.
Correct. I've got a natural buyer that has earnings.
Interesting. So thank you for sharing your views, both of you. I'm going to throw a curveball at you. What would change your view? What metrics are you looking at? And Matt, if you want to go first, that's fine. To change your views, right? I mean, clearly, if a recession looks deeper, you would have to adjust, right? What are you watching in the fourth quarter?
The biggest thing that's going to change my view is what happens with the debt ceiling. Right now, our view is that it'll be fine. We'll get down to the 11th hour, and then the deal will be struck, and crisis will be averted, and everyone will, go home upset and happy at the same time. If nothing is decided, that's just cataclysmic. That changes the math equation for everything: earnings, recessionary tendencies, buying behavior, everything. Everything gets thrown out of whack. The just operational infrastructure of how to deal with, what is really not so much like a technical default, but more of like a delayed payment. Because even if they miss a payment, it's gonna, once that breaks, they'll finally figure out a resolution. So that's the biggest thing that can just throw, as one person once said to me, it's like, be like throwing a cat into the middle of a bunch of pigeons. It'll just be crazy. That's the biggest thing right now.
Well, I have to change the question a little bit, though, because we're going to get through that. But in the fourth quarter, what might change your view around how you're positioned for basically a soft landing?
Yeah, so I think it would be if we don't see a trough in earnings revisions and earnings estimates. So right now, Q1 2023 earnings growth is expected to be around minus 2.5%. Q2 is still projected to be negative. Those bars have been lowered significantly. If we can't see firms, full-throatedly jump over that bar in the Q2 earnings results, and we don't see a trough in the earnings expectations, that would start to signal that there's more of a whole-scale shift in the earnings picture and the earnings quality picture, where that becomes more problematic from a forward-looking return perspective, because that means also something further beneath the surface has broken, and it's not just something that can be resolved with cost cutting, more operational leverage, and things along those lines.
So Patrick, I'll phrase the question at you too, just so we're clear on it. What would change your longer term view in the fourth quarter? In how you're positioned.
Yeah, I agree with Matt. The debt ceiling thing's a very bipolar event. Can't really manage around that. But we're paying close attention to the consumer. In my mind, that's still the biggest driver in the economy. Consumer debt on the credit card is starting to get close to $1 trillion. Interest rates on that are pretty high. Student loan payments are going to restart here later this year. And let's face it, the consumer really only had about a year's worth of inflationary pressures that they had to account for. Well, now we're into year 2. budgets get a little tighter. They might pay on the credit card for a while longer, hoping prices go down. But if they don't, all of a sudden, wait a minute, I can't afford that anymore. And that could be a quick event, right? You could have it happen in about a quarter where all of a sudden, wait a minute, I'm tapped out. We can't spend money, whether it's trips, whether it's, buying the new TV, etc., or shopping at home improvement. So we're pretty cautious on the consumer because as you stay at these elevated prices caused by the inflationary pressures, I think it takes time to work its way through the system. It takes time for consumers to change their spending habits. And later this year, I think you're going to start to see it.
Another curveball question. I spend too much time perhaps thinking about Apple. It's a separate asset class, but you were talking about earnings, Matt, and well, Apple's earnings are not, what's the word I'm going to look, inspiring, right? In terms of as a growth company, right? But when you're talking about S&P earnings, you have to be considering what Apple does, right? How much thought do you put into what Apple is doing?
Well, it's not so much what Apple is doing as far as, what the larger mega caps are doing, right? Because that drives the aggregate earnings. I mean, you're basically buying 7% of Apple's earnings when you go into the S&P 500. The aspect of how important is Apple's earnings only goes to the sort of headline growth number. But what you want to see for durability of a rally, right? Durability of forward-looking gains is that it's not just a few names driving either earnings, headline earnings growth, or headline market gains. So looking at the average is helpful, but what the median company is earning, and that median number is not really supremely attractive at the moment. So, Apple's earnings obviously have a big play into it, but also that's why the market's up 10%, because you're buying a lot of high quality names at the top of the cap spectrum that have repeatable cash flows, that have wide moats, that have user bases that are essentially synonymous with Americana. I mean, the fact that Apple's market capitalization is bigger than the entire market capitalization of the Russell 2000 index is striking. And, again, this is a different topic, but people are like, well, that's, indexing, yada, yada, yada. Well, a lot of people own Apple phones. They make a lot of stuff. They make a lot of money. A lot of people use Google. I see a lot of Amazon trucks going through my neighborhood. So, they're big for that reason too, because they make a lot of money. So you have to sort of weigh what those companies are making from an earnings perspective in terms of what that would mean for forward-looking returns. Because if the market all of a sudden is not able to keep up with some of the strength of a few stalwarts, that poses a bigger problem for the long-term sustainability of market gains.
Patrick, you want to run with the question?
I'll be more to the point. Does anybody on the call still use AOL for internet? They were a pretty big company back in the day.
I will say my parents do still have an AOL email address.
I do, yeah.
Well, I mean, here's the point, though. I mean, Apple's revenues were down, and they're pretty much a monopoly at this point. So do I justify a 30 times earnings ratio for a utility stock or a monopoly? Probably not.
Yeah, I think Matt wants to avoid talking about specific stocks too. Sorry about that, Matt.
No. It's just it's one of those things where it becomes very myopic of one stock. How much is that going to be in terms of driving the broader investor buying behavior? Apple's supremely important. So isn't some of those other companies. But the big thing for me is what is the sustainability? It's the same thing when you have a short covering rally. And we saw a lot of those in 2021, where all of a sudden the market was up 10, 11%. And it was and if you look at it from a quant perspective, which we tend to do a lot here, you look at quant factor baskets, it was high short interest, high leverage, low quality. And to me, that was like, well, that's not sustainable, because how many times are people going to go out to the market and buy literally things that are not of good quality? And now here's the inverse. You're buying a lot of good quality, but it's not significantly through the cap spectrum.
A pet peeve I have, and is Wall Street nomenclature. Nobody wants to buy junk bonds. They want to buy high yield bonds, right? You know, that I understand. But exactly what quality means isn't always clear.
Oh, no.
Yeah. So you've used that word a bit. Help us out with what your meaning is.
Well, you could use the Petrovsky's F score, which is a 9-factor input for quality, or you could just look at something more basic. Firms that have high return on assets, low debt to equity, and low earnings stability. So if you look at the standard deviation of earnings over the last 3 to 5 years, that is more of a significant, not really say significant, that's a more easier way to explain sustainable, durable, repeatable balance sheets and cash flows, right?
Yeah, I think our focus is on cash flow. What can the company do with that extra dollar of free cash flow? It can reinvest in their business. It can innovate. It can pay a dividend. It can buy back the stock. So if you have a tremendous amount of free cash flow yield in the company, you can do a lot of good things with it if you got a quality management team. So our emphasis is truly on that. You can pay down debt, as Matt mentioned, having the low debt to equity. So our focus is more on cash flow, and that junk rally that we talked about, the low quality names, I don't know if any of them had positive operating cash flow. I'd have to double check on that, but some of the names that were up 200-300% back in 2020, 2021 might not have that.
Gentlemen, we're at the top of the hour. This has been very constructive, another word that is often used on Wall Street. I appreciate your time, Matt, Bartolini, Patrick, Bobbins as well. Thank you very much. I'll go first to Pat. I mean, is there a place that people can learn more about what you do? An email address that you want to share, or a website that you want to address?
Yeah. So on top of being a wealth advisor here at Wealth Enhancement Group, we're also an index provider at Adaptive Wealth Strategies. So we've got a website, adaptivewealthstrategies.com. You can find some of our strategies there as well.
Matt, SSGA?
Yeah, ssga.com, full of a lot of insights, capabilities, and real-time market commentary from myself and other thought leaders within the firm.
Thank you, everybody, for being guests on the show. We appreciate it and look forward to the next Get Think Tanked.
Thanks, Dan.
Bye-bye. Thank you.